The strangest thing about retirement taxes is that they don't start with a tax form, they start with a missing machine. For years, your paycheck had a quiet little tax department built into it. Money came in, federal tax came out, Social Security and Medicare taxes came out. At the end of the year, a W-2 arrived and made the whole thing feel official. Then you retire, and the paycheck stops. But the IRS calendar doesn't. The big surprise isn't that retirement has taxes. The surprise is that the payroll department retires with you. Now every dollar has a new question attached to it. Where does this retirement dollar show up? So picture Linda. She's 67. This is her first full year without a job paycheck. She has Social Security, a small pension, some savings interest, and maybe one IRA withdrawal to fill the gaps. Nothing about that sounds wealthy. It sounds normal. What changed isn't her life. What changed is the machine around her life. Before retirement, payroll quietly turned income into after-tax money. In retirement, the income often arrives more like parts on a table. One piece is Social Security, one piece is pension, one piece is an IRA, one piece is interest. The IRS doesn't assemble those pieces for her during the year unless some part of the system is told to hold money back. But normal retirement income can still feed several different systems at once. $1 can help pay bills, create taxable income, change how Social Security is taxed, start an IRA deadline, and even affect Medicare premiums later. That's the whole story of this video. The first rule sounds almost too simple. The IRS says federal tax is pay as you go. In plain English, tax isn't only something you settle next April. It's supposed to be paid during the year, either through withholding or estimated tax payments. And the IRS gives a very practical trigger. Individuals generally have to make estimated payments if they expect to owe $1,000 or more when the return is filed. That doesn't mean every retiree must send quarterly payments. It means the old paycheck system may need a replacement. This is the first emotional turn. April is not the beginning of the tax story. April is the receipt. The real story is the year that came before it. If money came in all year and not enough money went out to the IRS during that year, the tax return can feel like a surprise bill for a decision nobody remembers making. That replacement can be different for different income streams. A pension can often have withholding. IRA distributions can often have withholding. Social Security can have voluntary withholding, or someone may pay the IRS directly during the year. For Linda, that might mean choosing withholding on the pension, asking for withholding from Social Security, or making estimated payments if the other pipes don't cover enough. None of those choices is glamorous. But this is the boring work that replaces the employer's payroll office. It turns one big unknown April number into smaller decisions made before April. The reason this matters is that underpayment penalties aren't just a scary phrase. IRS interest rates for underpayments were 7% in the first quarter of 2026, 6% in the second quarter, and 7% in the third quarter. The rate changes, but the idea doesn't. Missing the timing can cost money. Here's a simple way to feel that. If a retiree ended up $1,000 short and the annualized rate around that time was 7%, the pressure is roughly $70 over a full year before the IRS timing details. The real calculation can be more complicated, but the feeling is easy. The penalty is the system saying, "You paid me late." Now, Social Security has its own practical switch. The IRS says Form W-4V can be used to request federal withholding from Social Security benefits, and Social Security says you can choose 7%, 10%, 12%, or 22% from the monthly payment. That doesn't make W-4V a magic form. It doesn't know your pension, your IRA withdrawal, your interest, or your spouse's income. But it shows the first handoff. When the paycheck goes away, you either build a new withholding pipe, or you risk waiting until tax time to discover the pipe was missing. So the first section answers the simplest question: who sends tax during the year? If the answer used to be my employer, retirement changes the job. If the answer is now nobody yet, the first warning light is already blinking. And this is where the story gets less obvious, because the tax issue isn't just whether Social Security itself is taxable. The issue is what the rest of your retirement income does to Social Security. The IRS formula starts by taking one half of your Social Security benefits. Then it adds your other income, including tax-exempt interest. If that total is above the base amount for your filing status, benefits may be taxable. The base amount is $25,000 for many single filers and $32,000 for married couples filing jointly. Notice the little detail that makes this formula feel unfair to people who aren't ready for it. The formula doesn't only look for wages. It can see interest, it can see IRA distributions, it can even include tax-exempt interest in the calculation. That doesn't mean every dollar is taxed the same way. It means the formula is wider than the viewer may expect. Those numbers have a long shadow. Social Security's own history of the 1983 amendments says that beginning in 1984, up to one half of benefits became taxable above those same $25,000 and $32,000 thresholds. So this isn't a new retirement annoyance, it's an old rule living inside today's retirement budgets. Back to Linda. Say she receives $24,000 a year in Social Security. The formula starts by counting half of that, so $12,000. If she then takes an $18,000 IRA withdrawal, this simple example puts her at $30,000 before even talking about other details. That clears the $25,000 base amount for a single filer. This isn't a full tax calculation, it's a map. The important point is that the IRA dollar doesn't stay inside the IRA lane. It can walk across the room and tap Social Security on the shoulder. That's why the recurring question matters. Where does this retirement dollar show up? For a lot of retirees, the mental model is separate checks. Social Security is one check, pension is one check, IRA money is another bucket. But the tax system doesn't always see separate checks, it sees a stack. This is why a modest retiree can feel blindsided. The issue may not be one giant income source, it may be several ordinary income sources landing in the same formula. The viewer doesn't have to memorize the worksheet to understand the risk. If one more dollar enters the stack, it can change what happens to another dollar, and eventually one of those buckets becomes a clock. The IRS says retirement funds generally can't stay in certain accounts forever. For many traditional IRAs, required minimum distributions generally start at age 73. The first IRA RMD is due by April 1 of the year after the calendar year you reach 73. RMD doesn't mean the government tells you how to spend the money. It means the tax-deferred account can't keep sheltering all of it forever. Once the required amount leaves the account, the next choice depends on the household. The money might be spent, saved in a taxable account, used for bills, or handled through a qualified charitable distribution if that actually fits. That first deadline creates a sneaky timing problem. If you wait until the April 1 deadline after the year you turn 73, you may still have the next RMD due by December 31 of that same year. Two required distribution dates can land in one tax year. Imagine an example where the first required withdrawal is $20,000 and the next one is $21,000. Waiting might turn one planned withdrawal into a $41,000 distribution year. Again, those are example figures, not national averages, but the shape is the trap. That bunching is why the calendar matters as much as the amount. A retiree may think, I'll delay because I can, but the second question is, what else lands in the same tax year? If the delayed RMD shares the year with another RMD, a Roth conversion, part-time income, or investment income, the stack gets taller. The IRS also says that if required distributions aren't taken or aren't large enough, the excise tax can be 25% of the shortfall. It can be reduced to 10% if corrected within 2 years. That turns a forgotten withdrawal into a very real warning light. If the shortfall were $4,000, 25% would be $1,000. If corrected under the reduced rate, 10% would be $400. The numbers are simple enough to remember because the message is simple. Once the IRA clock starts, forgetting the clock can get expensive. This is the midpoint of the video, because RMDs change the whole problem. Before age 73, Linda might choose when to pull from the IRA. After the RMD clock starts, some income may become scheduled, and scheduled income can still feed the Social Security formula. That's why the years between the last paycheck and the first required distributions can be so important. Not because everyone should make the same move, because those years may have different income pressure. A household can look at the stack before the clock gets louder, instead of discovering later that every withdrawal now has 3 other formulas watching it. That brings us to the part people often describe as strategy, but the clean word is timing. Not hiding income, not beating the system, timing. One tool is a qualified charitable distribution, often called a QCD. IRS Publication 590-B says a QCD is generally a non-taxable distribution made directly by the IRA trustee to an eligible charity when the IRA owner is at least age 70 and a half. The IRS also says a QCD can count toward the required minimum distribution. So if Linda already planned to give to charity, a direct QCD can satisfy some or all of the RMD without the same taxable income path. But this isn't universal advice. If she doesn't want to give to charity, it doesn't fit. If the money doesn't go directly from the trustee to the charity, the point can fall apart. Another tool is a Roth conversion. This one gets oversold online, so keep it honest. IRS Publication 590-B says conversion distributions from a traditional IRA are includable in gross income. In plain English, the conversion itself can create taxable income. Think of it like moving a box from one shelf to another. Moving it can be useful, but the move itself may set off a tax event. The planning question isn't, can I make the tax vanish? The better question is, if this income has to show up somewhere, which year is the least damaging place for it to show up? The possible advantage isn't that the tax disappears, it's that some retirees may evaluate conversions during lower income gap years, before RMDs begin and before later income stacks get heavier. A conversion can be a way to choose the year. It isn't a promise that the total tax bill goes down. This is where Linda's control panel becomes useful. The same $1,000 doesn't have one identity. If she takes it as an IRA withdrawal, it may help cash flow and raise taxable income. If she gives through a qualified charitable distribution and meets the rules, it may satisfy an RMD differently. If she converts, it may move income into this year on purpose. The dollar has a location, and in retirement, location means timing, tax treatment, and which formula sees it. The last gauge is Medicare. Medicare.gov says the standard Part B premium in 2026 is $202.90 per month, or higher depending on income. It also says Part D premiums can be higher depending on income. This is where retirees can get caught by the language. The extra Medicare cost doesn't feel like a tax bill, it feels like a healthcare bill. But the trigger can still be income. So a dollar that began as "I need cash from my IRA" can later feel like, "Why did my Medicare premium change?" That base Part B premium alone is $2,434.80 over a year. The surcharge system can add more for higher income beneficiaries, but the exact brackets should be checked before anyone uses them. For this script, the main point is safer and clearer income can move from a retirement account into a Medicare bill. So the IRA withdrawal that felt like cash today may not end with today's cash. It may show up on the tax return. It may affect how much Social Security is taxable, and for some households, it may help push Medicare premiums higher later. Social Security does have a process to ask for a lower income-related monthly adjustment amount after certain life-changing events that reduce household income. The SSA examples include marriage, divorce, death of a spouse, loss of income, and an employer settlement payment. But that's not the same as saying every one-time IRA withdrawal gets forgiven. That's why planning before the withdrawal is cleaner than hoping for an adjustment after the bill arrives. The Medicare meter doesn't make retirement taxes scarier, it makes the timing more important. So here's the practical framework. Not advice, a framework. In the first years of retirement, look at 4 gauges. Gauge 1, who pays tax during the year? Gauge 2, what income is entering the Social Security formula? Gauge 3, when does the RMD clock start? Gauge 4, could this year's income echo into Medicare premiums? The useful question isn't, what does the IRS expect every retiree to do? The useful question is, what changed because the paycheck stopped? If the answer is withholding, set up a pipe. If the answer is Social Security, watch the stack. If the answer is the IRA, respect the clock. If the answer is Medicare, check the meter before the withdrawal. That's the quiet handoff retirement creates. The tax system doesn't just ask whether you have income, it asks when the income arrived, where it came from, how it was paid in, and which other formula can see it. Retirement isn't tax-free, it's payroll-free. That's the part people miss. And once you see it, the whole problem gets less mysterious. You aren't just collecting separate checks, you're managing a control panel. So before the first retirement tax surprise, ask one boring question for every meaningful dollar. Where does this dollar show up? If the answer touches more than one gauge, slow down. Verify the rule, label the math, and don't let a retirement dollar wander through the system without knowing which warning light it might turn on. If this helped, like the video, comment with the retirement tax rule you want broken down next, and subscribe for more calm money explanations. Thanks.